Welcome to another episode of Equity Mates. My name is Bryce and we are here for Watchlist Wednesday, one of our favourite episodes of the week. And as always, I'm joined by my equity buddy, Ren. How are you going?
I'm good, Bryce. It might be one of your favourite episodes of the week. It is my favourite episode of the week. It's the perfect way to, you've got over the hump day, you've got over Wednesday. Yep. Now settle in for 15 minutes where we take you through three stocks. I'm going to hazard a guess that a lot of people won't have heard of these stocks before, so I'm excited to get into it.
Yeah, we are joined in the studio by one of our most popular and also favourite guests of 2020, and that is Nick Cregan from Fairlight Asset Management. Nick, how are you going?
Very well, and that was a very generous introduction. Thank you very much.
Well, I'm telling truth. I'm telling truth.
You say that to all the pretty ladies when they come on.
He knows me well. Nick, we are here today, as Alex said, Watchlist Wednesday, three stocks. So look, we may as well get stuck into it.
Great.
The first stock that you've sent on your watch list is Hexel. Ticker is HXL, and they're listed on the New York Stock Exchange. What's going on here?
Well, I thought sort of the thematic, and I think a lot of people have probably been talking about this theme of opening up and you know, what sits behind that. And there's a lot of stocks that are trading at all-time highs. So if you look at the Jets ETF, for instance, within sort of 5 or 10% of its all-time highs. So Hexel sort of participates in that space, but we think there's a little bit more value. So Hexel is one of the only manufacturers of aerospace-grade carbon fibre in the world. It operates in a really cosy duopoly between itself and a Japanese company called Toray.
Okay.
And there's massive barriers to entry here. So you need to be sort of certified by all the sort of aerospace certification programs. If you want to make a change to one of the programs, it's sort of a 10-year program to make those changes. So once you're sort of specced into an aircraft, it's very, very difficult to change. COVID kind of hits, and you know those sort of things throw a bit of a spanner in the works. But prior to COVID, Hexel had been nicely profitable even through the 2008-2009 GFC, and during this period, obviously 100% sort of closure of their major customers, which is Airbus and Boeing, sort of sent that business into a kind of a tailspin, if you like. But what we really like about it is got massive structural tailwinds behind it. So we think about sort of going back sort of a decade ago, carbon fibre was only sort of 5 to 10% of the overall materials that went into a plane. If we fast forward now to sort of A350s, those carbon fibre components are now 50% of those planes. Wow. So you don't actually need sort of new planes to be developed as long as the existing fleet gets upgraded over time. And we're very confident that is going to happen as jet fuel prices increase. The major way of reducing your weight is by using carbon fibre, which is some sort of 5 times lighter and 30% more durable than aluminium. So we just think that tailwind's going to compound out over time.
I like the amount of puns you've included in that answer. Tailwind twice, tailspin.
I didn't even notice, but there you go.
So it feels like the aerospace industry loves a duopoly. Obviously, Airbus and Boeing are the big duopoly, but there's another duopoly here. Why Hexel over its Japanese rival?
That's a good question. Hexel has got a slightly stronger sort of financial history and the returns on invested capital, which is sort of our hallmark of how we look at businesses and how high quality they are, generates that number with greater consistency. So that's the major reason. The other sort of question which you sort of threw in there is in duopolies is, you know, why would you choose this over, say, another aerospace manufacturer into the aftermarkets market, if you like? For us, the big piece is that once the carbon fibre is used, it can't be re-specced into another plane. So at the moment there's a situation where it's interesting to see how it's going to play out, but there's essentially a huge car park of planes out there that you can rip parts out of and use into existing aircraft. You can't do that with carbon fibre, so once it's used, it's used. So every aircraft that now rolls off a conveyor belt is now going to be using sort of higher percentage of those carbon fibre pieces.
Interesting. And so I guess if you're thinking about risks for a company like this, what are some of the risks that you're considering here? And I guess if your thesis were to change, what would you be looking out for?
Yeah, so it's actually one that that we've kept at a low weight until recently, and we've been increasing it as that margin of safety has been blowing out as the share price has moved away from what we think is intrinsic value. And the reason for that is it's probably riskier than many of the businesses in our portfolio. I think when we raced through our strategy with you guys, you would have got the sense it's recurring revenues, fully ingrained in your customer workflows, very hard to get rid of you once you're sort of in there, and a very small percentage of your overall costs of a service or a manufacturing facility or input, if you like. For Hexel, and then nice sort of diversification of the customer base. For Hexel, it's quite different. So off the bat, you're sort of thinking, well, you've only got two major clients here, Boeing and Airbus. Airbus is the sort of vast majority of that. The vast majority of your revenues are coming from just one industry, which is aerospace. So there's some huge risks there already. The other element, which is we don't usually get involved in what we'd call heavier industrial businesses. So those businesses that can't generate a good return on their capital through a cycle. Hexcel's proven to be able to do that in pretty much all environments until we hit COVID. But we are also mindful that it does have quite a heavy CapEx or capital expenditure program, so it needs to put assets in the ground to generate those revenues, which inherently makes it a little bit more cyclical. So we are focused on obviously the key client risk. We're also very, very focused on the potential for this business to be a little bit more cyclical than those companies that we typically hold.
We could do a lot more questions on that, but unfortunately we don't have the time. So we'll move on to the second company that you've given us that's on your watch list, Copart. CPRT is the ticker, trades on the NASDAQ. To start with, can you tell us what this company does?
Sure. So as you know, we take a high quality approach to investing, and as I start to describe it, you're going to really question whether this is a high quality business. So high returns on capital through an investment cycle is what we're looking for. But Copart is the largest provider in the United States of essentially what is a junkyard service. So it's the opposite of quality, right? Junk. But our definition of quality is the actual returns you generate from the assets you put on the ground. And their Copart is absolutely amazing. So what they do is they provide a service for the insurance industry, and they connect them to a large army of dismantlers and used car dealerships. So every time a car is either involved in an accident or there's a major hailstorm event or some sort of event, the insurance industry needs to get rid of hundreds of thousands of vehicles very, very rapidly. And so what the industry is sort of formed into is, once again, you get the theme here, a duopoly between themselves and IAA, and they've got about sort of 45% market share each. And there's this natural sort of barriers to entry that formed. One's physical and the other's digital. On the physical side, you literally have thousands of sort of independent lots around major metropolitan cities. It's very hard to get those leaseholds or land holdings again, because you're applying to the council for what would be a junkyard near residential housing. So that's kind of in place. There's no real way for people to break into that industry. And the second piece is that natural digital, and it's a bit of a sort of a cliche these days talking about flywheels, but here is one, and it's essentially that Amazon or eBay or whatever flywheel where sort of more sellers begets more buyers and more buyers begets more sellers. So you've rolled up all the insurance industry. Now that's attracting more buyers. That becomes more valuable to the insurance industry, and so that flywheel continues to roll on. So much so that they've now managed to expand into international markets outside of the US, and we think there's a long runway for that business to grow in Europe.
Fascinating. This is why we love talking to you, because it's coming up with companies that would just never imagine trying to find. What is the process that you kind of go through to find something like that?
We run sort of screens across the market using Bloomberg and FactSet like everyone else does, and that sort of drills us down to about 250 companies that are of interest to us, and we run sort of some financial metrics as well as developed markets. We're only invested in 4 sectors. Yeah. That makes things a little bit more manageable, but really the special sauce is a lot of the time just getting out on the road in normal times, and seeing businesses and asking them about their competitors and their suppliers, and you can draw these sort of maps end to end about how industries work, and if you can plug those holes over time, it's usually the magic's in the detail, and so you can sort of find these interesting little businesses that dominate niches, obviously sometimes acting in oligopolies or rational duopolies. And they sort of fly under the radar of most investors, but it's really just putting the hours in. We're pretty boring guys. We just like reading 10Ks.
So you mentioned international expansion there, and You spoke about the moat it has in the States,
Yep.
and it's rolled up all the insurance companies, it's rolled up all the junkyards. As it tries to expand internationally, is it going to face that entrenched moat with local players in other markets? Has the Australian market already got companies with that moat? Have European countries already got companies with that moat? Are they going to be able to be successful in expanding?
Do you want a job, Brent? Because you're asking all the right questions. As they expand into Germany, for instance, it's less about taking on the incumbents, but actually changing the model. And so the model in Germany, for instance, with the country they're currently taking on, it's been a very antiquated but very different system, and so they've had to make some investments. And I'll tell you the reasons why. So in the States, it's very straight cut. So the insurance company maintains title of the vehicle until it's sold on to the end dismantler or used car dealer or whoever it might be. But through that process, the person that was involved in that accident is no longer involved in managing that process. So they're taken out of that process, and it's highly efficient. So it's corporate to corporate sort of dealing in that transaction. In Germany, it's a very sort of antiquated system where the accident happens and then it's up to the consumer to figure out how to dispose of that vehicle, which is so backwards for a country that's amazing in sort of automating systems, etc. So Copart's had to go in and actually make investments, and they've said, okay, we're going to have to take title of these vehicles, and then we'll change the model over time so that the insurance company and the end market guy can transact one-to-one. And so they've been developing this system, and they've been growing exponentially as a result, but they've had to put some money in to sort of grow that model over time. So they're not taking on an incumbent, they just had to change the way the market works.
Wow.
Fascinating.
So moving to the last stock, Nick, and that is Temenos. Hopefully I've pronounced that correctly. The ticker is SWX, listed on the TEMN. Couldn't tell you where that is.
Has he got that the wrong way around?
Could be.
Yeah, I was going to say that doesn't really match that, but anyway.
That's right. I think it's listed in Switzerland, but they're headquartered in the UK. It doesn't matter. They basically dominate the European market for banking software. So if you're a bank, still sort of 80% of the software, especially for the majors, they'll develop their own core banking software, and usually the other software that sits adjacent to that, which helps their employees sort of onboard clients and do digital marketing, internet banking, that sort of stuff sits as an adjacency. But around 80% of that software is still developed internally. But Temenos has spent the last sort of 10 to 20 years, or longer than that, developing a client base, which that referral base is becoming more and more powerful over time. So banks becoming more comfortable outsourcing what they used to see as their core competency. As a result, the banking industry is growing at about, the software banking industry is growing at about 8% per annum, but Temenos is growing share within that, which is really important. The big element for Temenos more recently is they're trying to break from Europe into the United States, which is a much bigger market. They've sort of given up on the core banking side there, but there's a lot to provide around that sort of second element that I described, so the digital banking, internet banking, sort of onboarding of clients, etc., and they're making some real toeholds there. The big element that they've seen recently is sort of coming out of this COVID period is that they need their sort of core guys, their consultants, etc., to be on the ground with their clients to help with these big sort of implementations. And so revenues were down some sort of 11% in the last quarter, but they still generated 12% earnings growth, which just talks to some pretty strong management within that business to sort of manage that cost base. So they're coming out of this period, accelerating their market share gains because they spend twice as much on R&D as their next largest competitor, and their win rate is twice as strong in their licensed software than it is their next largest competitor as well. The whole model is now shifting, and you guys might have had people on talking about how sort of software is shifting from license to software as a service now, and what that means for sort of recurring revenues, etc. The big fear for Temenos was that as they were making that transition, their margins were going to take a real hit. And so the market was positioned for this big downgrade. And the nice thing that sort of came, we were positioned ahead of that because we're like, well, we don't really care if next quarter's or next year's earnings are down. The NPV of that project as you transition from license to software as a service is some 40 to 50% higher over the life of that contract. So we were very happy to take a long-term view. As it's transpired, they've come out in their most recent investor update or their investor day, and they've said, look, our margins are going to be just fine. 120 basis points adjusted and 40 basis points higher if you just use the GAAP earnings. So to us, that's fine.
Wow. We love software as a service companies. We love software as a service companies with a network effect, and obviously the US market does as well. Looking at some of the multiples that some of those companies are trading at, is there a network effect here? Like, does it improve interoperability between banks if they're all using the same software? And is it one of those things that if Temenos can start winning more and more customers, that'll, I guess, to talk about flywheels again, it'll be this, self-reinforcing cycle where more and more banks want to use the same software platform?
You're on fire, Ren, because
this is my job.
In their investor update in the last, the one that they provided, one of their arguments against, so if you think about Temenos, they're almost like the SAP of banking. So they are the guys that sort of put themselves out there as the one-stop shop. We've got all these different solutions that sit under our core banking infrastructure. But if you're an up-and-coming service provider or a software provider, you can plug in via APIs. But they also make the debate that if they're competing with those companies rather than partnering with them, how do they compete? And their big argument is all of these banks provide us their data voluntarily, and we're able to use that as benchmarking data to provide these banks where they're at best practice and where they're not, and that's how they can improve their services. So that is not so much a network effect, but it's an interesting way of sort of using that network, if you like, to provide a service to those guys that allows them to get through. The second thing is absolutely, so there is efficiency gains, especially in places like the States where you've got ACH network payment systems, which increasingly the banks are moving away from because they're so antiquated. So usually you have to batch the payments on at the end-of-day basis rather than do real-time banking on a sort of second-by-second basis. Temenos can help with that by providing sort of direct pipes between the two banks. So there is that element, but I wouldn't call it the true kind of network effect that you get from a consumer-facing business, for instance.
Yeah.
Well, Nick, unfortunately, that is all we have time for today. We can chat about this all day long, and we're certainly going to have to get you back on for another Watchlist Wednesday. So just a reminder, we had Hexel, ticker HXL, Copart, ticker CPRT, and Temenos, ticker TEMN.
Perfect.
Very much appreciate your time. It's always a pleasure.
That flew. Thanks very much, guys.
It did fly, unfortunately. And that brings us to the end of another episode of Equity Mates, another Watchlist Wednesday. If you would like more information on Equity Mates, head to equitymates.com. Follow us on all the social channels, or you can send us an email at contact@equitymates.com. But Ren, we close it out tomorrow with a few news articles.
That's it. We're talking about two stories that have caught our eye. Howard Marks has released another memo, so we'll unpack that. And then we're going to be talking about deep learning and machine learning. You hear that a lot in investor updates and investor calls. And so we'll be unpacking a story that caught our eye on that topic.
Yeah.
So make sure you tune in, same time, same place. Until then, thanks for watching.